Well, listen, we are thrilled to have a sponsor step forward for this meeting. And I'm really excited to have gotten to know this gentleman, John Lamar, with Paragon HVAC. And as people are filtering through the room, and we got about 100 folks on. John, tell us a little bit more about yourself and about your company. And thank you for the
Absolutely.
sponsorship. Thank you.
Of course. Thank you for the opportunity. This is a very exciting topic. So yeah, as Mike mentioned, I'm the president owner of Paragon Heating, Cooling, and Tankless. We cover all the greater Chicagoland area. About half of our business is commercial, half is residential. And we are a non-union shop and we're non-private equity owned. Why does that matter to you guys? Well, as someone who's had over 40 doors investing in Chicago, I know the importance of having a good partner, someone that you can trust, someone that's not focused just on um, profitability, bottom line, which is what a lot of the private equity firms that have been acquiring HVAC companies have been doing. Um, we could do anything from rooftop units to very complex boiler work, all the way down to forced air, chillers, walk-in coolers, the whole nine. We have some really great techs that are focused on solving problems and not focused on gouging customers, which we get a lot of customers from other large block HVAC companies that have been burned before, and we'll take those people with open arms. But anyway, I'm sure as you guys are, have, own your own buildings, you probably have your first string HVAC person. That's completely fine. We're just asking if you need, it's good to have that second string, especially the top of a season, or if there's complexity where crane's going to be needed, welding, big type projects. We love to take those on. So thanks again for the opportunity to sponsor this. And I'll put our website in the chat window. You guys can check it out. And thanks again. I'll hand it over to you, Mike.
John, your company is Paragon, and what was the words after Paragon?
Paragon Heating, Cooling, and Tankless.
Well, being in real estate, we're all familiar with how it feels to be tankless without
Mhm.
nobody shows you gratitude or appreciation anymore, right?
Love it.
All right.
I love it.
So anyways, we have about 130 folks on the call, and I think it's time to get started. We first had this idea of having this kind of panel discussion shortly after this big bill was passed. And I think it was smart to wait a little bit and give it time to the reality to settle in. We're not going at this from a position of support or opposition. We're realists in our industry, and we're going to take what we have and figure out what we do with it. So there's no editorial comment politically, yes or no about this. We're dealing with what we have and how can we utilize this bill to run our businesses and perhaps bring some positive results in terms of greater affordable housing and other benefits. As terms of our moderator today, we have just a tremendous friend to the NBOA, somebody I've gotten to know during COVID, Don Vincent, who has a couple of roles, but primarily we know him because he's the editor and publisher of the Daily Line, which is an outstanding electronic news source on political events. Don and his team do a great job covering the important legislation that's proposed at all levels of city, county, and state government. And Don has just been a really good friend of the NBOA. So with that in mind, Don, I turn it over to you and your great skills I'm sure you'll show in moderating this discussion. So I'm going to bow out and thank you all for being here.
Thanks, Mike. I appreciate the kind words and always great to collaborate here with the Daily Line. You guys do important work, and I'm glad to be part of the circle, or at least navigating around it with y'all. But yeah, great. We're going to be talking about the big beautiful tax bill that was passed in early July, actually on July 4th. This was a big bill that I think a lot of people in our in this industry um, was waiting for. There's a lot of components to it that potentially bring certainty and will enable people in the housing industry and the real estate industry to chart a path forward. So, before I go any further, I definitely want to introduce our panelists today. Joining us is John Chang. He's the Chief Intelligence and Analytics Officer at Marcus and Millichap. Thank you for joining us today, John.
Hey, thank you for having me.
You bet. In a minute or two, I'll let you guys all talk a little bit about the roles that you serve and kind of your focus. So bear with me a moment, and we'll get into that. Also joining us today is Brian Bianchi. He is the Senior Vice President at Northern Trust. Welcome, Brian.
Thank you. Good to be here.
Not able to sign in and habitually with technology issues is Kevin Cawley. He'll be joining us here as soon as he can. He is a senior account manager at CSSI, that stands for Cost Segregation Services Incorporated. Many of the folks on this call will know him as Cost Seg Kev. He's definitely going to be able to talk to us a little bit about the benefits that this bill brings to accelerating depreciation when it comes to commercial real estate. So, John, yeah, I'm sorry, was somebody
I'm here just under Don Vincent up here.
The second Don Vincent. Welcome, Kev.
I used your link. Don Vincent number 2.
All right. If you all could help us get that, or Joel, or if you guys can help us get Don Vincent number 2,
I can.
great. So that we can focus on you in our panel here. But nonetheless, Kev, you want to introduce yourself?
Sure. It's Kevin Cawley. Going, I guess many of you have worked with, some of you have spoken with. See cost segregation studies. Our firm CSSI has been around 24 years, done 55,000 successfully completed engineering based. We've added 179D, which is an energy efficiency credit for developers, to our repertoire of services and our tax credit services. But happy to be here, add some insights once we start getting through the panel intros and from there.
Appreciate it. John, if you wouldn't mind, just kind of give us a little, quick minute or two on what your focus is at Marcus and Millichap.
Hey, thank you. So I lead our research services team, which is basically charged with gathering and synthesizing all of the data and information about the economy and commercial real estate, weaving it together into something that people can understand, and then translating it into tools and information and resources that investors can use to make better informed decisions. So we're covering the US and Canada, most of the major markets across both countries, and happy to try to help investors invest in commercial real estate and buy, sell, and lending for commercial real estate.
Fantastic. Thank you. And, as we go along, I do want everybody to know that, we have the chat open, so you can always ping questions in there. If there's something specific that you want us to dive a little deeper on, please make that known. There's also, I think you can raise your hand on this app as well. Throw that hand up in the moment and we'll try to call on you. Brian, talk us a little bit about your work at Northern Trust.
Yeah, absolutely. Thanks, Don. So I work here at Northern Trust along with a multidisciplinary wealth management team, including wealth management personnel, estate planners, former attorneys that have kind of worked on planning very complex estates, and investment professionals to kind of surround our clients with all of the services that they need. My specific focus is more on the lending on the credit side, and kind of over the years spent a lot of time working with commercial real estate owner operators and developers, and then working to, again, kind of surround them with the additional knowledge and service that they ultimately end up needing, some of which is certainly going to be discussed today.
Excellent. Well, to kind of give a little bit of a rundown on what we're going to be talking about today, and some specific components of the big beautiful bill, we're going to delve a little bit into the tax rates, deductions, estate tax. We'll cover 100% bonus depreciation, and if we can bring some qualifiers as to what does qualify and what doesn't, and obviously there's a cost segregation component to that as well. But Kevin did bring this up. We're going to be talking about Section 179 and potentially, if we have time, 179D, energy efficiency deductions. And then, without a doubt, we should definitely talk about SALT, qualified protection property, and if we have time, QBI and excess business losses and whatnot. So there's also a little added component to research and development R&D tax credits that we can touch on if we have time. But more than anything, we're going to kind of hammer through some of these topics and then save some time at the end of the call for questions that we didn't get to address during the call. So yeah, so let's kind of kick off. John, what would you say is the kind of the highlights of this bill that commercial real estate investors should be paying attention to?
Sure. So, I gotta say, I am not a tax expert. I'm not a CPA. I'm not licensed to really talk about taxes. And my focus is really on how the new tax law impacts the investment in commercial real estate and how some of these changes could impact decision-making by investors. And so when this was coming together, it was a moving target right up to the last minute. The first thing that was most important to me was that 1031 tax exchanges were maintained. Carried interest is another piece that was targeted right up to the last minute, but actually did not get touched. So that was a real positive, especially for equity funds and syndicators. The qualified business interest deduction, the pass-through was made permanent at 20%. That was a number that was moving around, again, right up to the last minute, but they locked in at its previous level of 20%. The state and local tax deduction was increased up to 40K. It was 10, but it phases out after incomes exceed 500,000. The bonus depreciation was made permanent at 100% bonus depreciation. That is probably the single biggest change here. It was phasing out from the 2017 bill or law, and it was down to 40% for 2025 in bonus depreciation. So that got bumped back up to 100% and made permanent on all deals going forward. They doubled the Section 179 equipment and software deduction to $2.5 million, which is good for value add deals or when you need to make other expenditures after you buy a property. Opportunity zones are coming back in 2027 under a better refined model, a lot more clarity. They changed the step-up basis. Previously, you'd get like 5% after, I think, 5 years, another 5% of step-up basis after 7 years, and then there was a special provision that gave you a bonus 5%, taking your step-up basis to 15%. After multiple years. Now, under the new model, which they're still working on, it will come out in 2027, has a 10% step-up basis after 10 years on capital being brought into commercial real estate from other types of capital gains. So basically, if you sold stock and you have capital gains there, you could move that money into commercial real estate through an opportunity zone fund and get a step-up basis on that, so you pay less taxes. And then the last thing was a modest increase in the estate and gift exemptions, increased to 15 million for an individual, 30 million for a couple, and again made permanent. So the biggest thing in my mind, there are a couple things that are most important. One was increasing the bonus depreciation on acquisitions because that could take some marginal deals and move them into a cash flow positive position. I think Mike Glasser has a lot of insight into that. It does require looking at the property and identifying the parts that can be written off. But the other thing that I think is probably even more important is that it stabilized the tax rules. Prior to this, the 2017 rules, many of them were scheduled to phase out over time, and you're always planning on things getting changed in the future. And this new law stabilizes it and made a lot of these things permanent so you can make longer term planning on your investment. And I think that's going to empower a lot more investors to make better informed decisions. They're not waiting for something to change that's not volatile and variable depending on the whims of Congress on any given year. And that really should help bring more capital into commercial real estate and also bolster values a little bit just by having increased stability on the tax policy.
Wow, that was a fantastic way to kick this off, John. You really kind of delved deep into a number of these enormous benefits for property owners. You know, I think we all kind of operate here as if we all know what all this stuff is. And you know, maybe you can just kind of give a quick little summary of what a 1031 exchange is and what classifies as a Section 179.
So 1031 exchange is an enormously powerful opportunity in commercial real estate. You don't have this with with stocks or anything else. But basically, you can sell a property and roll over your capital gains to buy a new property and not pay capital gains taxes on that profit. And you can continue to roll this multiple times. It's your each property you're going to want to you buy a more expensive property and you reset. Not reset. I gotta be careful. Your depreciation carries over into the new asset. So if you have a fully depreciated property of whatever, $1 million, and you go buy a $2 million property, you're carrying that $1 million of depreciation over, but you don't pay any taxes on the capital gains because you're reinvesting it. And what this allows investors to do is to build their asset base over time. They buy something, they create value, they add value to it, it goes up in value, and they sell it. They take that capital, they roll it over into another piece of real estate, and they avoid the capital gains for now. And one of the big opportunities there, as at Marks Millichap, we do a lot of these, and one of the things investors do quite frequently is they'll own apartment buildings, they own them, and they buy them, they accumulate them over their life, and then they look at their kids, and their kids want nothing to do with real estate. So they can then take it and roll it over into, say, a net lease deal, a triple net deal, office building, industrial building, or a retail property, and that have no management responsibilities and still pass that that real estate onto their kids or their people that inherit this. And the advantage is that they avoided those capital gains all the way through, and they pass it on. And eventually, when they pass, they get the step up basis, and it moves up to the next level. So you can really, through 1031 exchanges, defer taxes on your capital gains for the rest of your life, and then it gets reset when it's passed on to the next generation. So that's a big one. The other one you mentioned was Section 179, and basically, now again, I'm not an expert in this, but my understanding is that you're able to write off products, things in your buildings, for example, that you buy. So, for example, if you purchase a new apartment building, not a new, but if you acquire an apartment building, you go in, do a light value add, you buy some appliances and some, do some work on it, and maybe change some HVAC. That these things may become a tax write-off right when you make the acquisition. So you, instead of expensing those over the life of the equipment, whatever, 5-7 years, you get to write it off right then. And again, I think for new property acquisitions, especially value add, light value add, this is an opportunity because you're not taking that hit. You're getting the tax write-offs right up front between that and the bonus depreciation that may take a marginal deal and move it into a cash flow positive scenario by nudging it over the line on the tax consequences.
Wow, what a strategy. Brian, I know you had some thoughts too on just the bill in itself, but maybe where it comes to estate taxes or we talked about 1031 and 179. Do you have any additional thoughts to add there?
Yeah, and really what we were thinking of for our clients, and a lot of the concern and sort of the scrambling around having to plan was really on that estate tax issue. And just as a reminder, this is one of those provisions in the federal tax code that seems to have jumped around as much as anything over the last 15, 20, 25 years. And the most recent action prior to this, bill was in the Tax Cut and Jobs Act under Trump 1. So that action increased the exemption amounts, the amount of your assets that are exempt from taxation at the estate level. But it was, of course, set to sunset after this year, which was, everything that prompted all of this action this year. So had nothing happened, the exemptions would have gone down from 13.9 million this year down to 7.4 million for individuals. So you can kind of think through even just a few apartment buildings that you've had for years and years would very quickly exceed that level in theory. So I think this was a very important action to take. And again, as John alluded to, it's for at least as far as we know, for as long as until it changes, it's a permanent change to the structure of this provision. And the best part is it indexed for inflation. So we will continue to see these levels increase. Obviously, we know what inflation's done the last 3-4 years. These levels will change and are again permanent for as long as until somebody else changes them. So next year, I think as John alluded to, we're going up to it's 30 million per couple next year and 15 million individually. So for people that are still fortunate enough to be in above that level, there's certainly planning opportunities and gifting opportunities to do. But I think, we eliminated the real kind of concern around that provision going away and sort of really helped us to sort of, eliminate the real need to do some immediate planning like this year, which I think a lot of people were concerned about. Was there even enough people to kind of get to this when, if nothing were to happen? So for us, and I think for a lot of people on the call here, that's certainly one of the biggest provisions that we were thinking about.
Excellent. Thank you. Kevin, I want to bring you in here because I know through our conversations, you've talked a lot about your clients utilizing accelerated depreciation, taking advantage of the 1031 exchanges. Maybe talk a little bit about their strategy and how they've implemented this in the past, certainly through the 2017 bill, but how you can see people utilizing this on a go forward.
Well, first of all, can you hear me well?
Yes, we can.
I know I had some technical, and I'm Don Vincent too, not Cossack Gab, I'm Don Vincent too. But I like what John and Brian both brought up. The 100% bonus, it's a sexy thing. I want to start it off by saying, hey, just because 100% bonus is here doesn't mean you own a property, you should do cost seg. So I always start off there. The planning, Brian and John, you mentioned planning, okay? So now that we got 100% bonus, you want to make sure you're holding a property long enough to offset your taxes, take the money you're not paying taxes, invest it. So whether it's 60% bonus, 80 or 100, the whole point is you still need to check some boxes on who you are and what you're going to do with this asset. So anyone who's going to sell within, I'd say 3 years, 5 years, maybe let's say minimum, you want to hold the building 5 years minimum after doing a cost seg to take these proceeds, put them to work for you, because when you sell, whether you do cost segregation or not, there's depreciation recapture. So maybe just let me give you an example. If I bought $1 million warehouse, which would be a 39-year asset, we segregate 25% of those assets in the 5, 7, 15 year. That's $250,000 deduction, right? Upfront today. Well, whatever your tax rate is, we multiply the 250 times that. Now, whatever that money is, you're going to offset your income tax by. The point is, if you're going to flip that thing in 2 years, all of the money that we just freed up for you, you're going to have to pay back 100%. So I want to start off by saying not rah, 100%. If you own a property, you should do a cost seg. More so, you got a plan. You want to talk to your trusted advisors and start there. And then if they say, well, yeah, you're going to hold this a good amount of time, your investors are on board, let's do 100%. let's do a study and trigger a cost seg group that where we could put 100% to work. Another thing I love that John brought up and Brian touched on was the 179 immediate expense limitation doubling. John, did you say it's 2.4 mil now? 2.4, I think.
2.5.
2.5. I made a note. For a lot of my clients, and like you said, some deals that may not look good on paper with this expense deduction going up to 2.4, it's massive. So guys, what that means is you buy a property, a multifamily property, you're going to redo half the units this year. Well, if you're doing a lot of interior components, spending that money, you're going to have a $2.45 million actual expense. Expensing, so 179D or 179 that John brought up, expensing is always better than doing cost seg on. It goes right off your depreciation schedule. So what we're seeing a lot now is collaborating more with the clients' CPAs or tax guys, because they'll say, hey, Kev, run your cost seg analysis, but we're going to expense everything we can up to that amount. Everything thereafter is what my team and I would look at. So it's a really good thing where some projects that may have been included on in the past don't need me anymore because of this expense limit. So it's a really good thing. That I just want to chime in on that because that was a great point. I made a note of that. That's a big positive for real estate investors.
Undoubtedly. And you know, I got a couple of side texts here, Kevin. You know,
Sure.
for everybody on the call, you know, and you know, we are up to 165 people here, so that's awesome. Can you just give a quick 30-second recap on what cost segregation is?
Sure. So cost segregation is simply the act of taking a building apart on paper and segregating, right? Separating all the parts and pieces that won't last the life of the building. So to keep it brief, if you buy a commercial asset, the government lets you write that off over 39 years. So they give you 1/39th per year in write-off. If you buy a multifamily property, you can write it off over 27 and a half years, right? So 1/27th and a half each year. So what we do with cost seg is we say, wait a minute, there's a lot of parts and pieces and components that make this building what it is. Not all of them are going to last 39 years or 27 and a half. So through an engineering strategy, we literally take the building apart on paper. We'll say, hey, the flooring, the cabinets, the trim, the carpeting, none of that's going to last 27 and a half years. It'll last 5. And they got a small parking lot in back. So we'll say the parking lot striping, paving, all that won't last 27 and a half years. It'll last 15. Each of these items we put values on. And now instead of depreciating the 5-year assets over 5 year, the 7 over 7, 15 over 15, with the big, beautiful bill President Trump enacted, said, hey, all of those values, you can depreciate 100% upfront today. So we're seeing guys take 20, 30, 35% deductions on their purchase price upfront today, which is the time value of money concept. So you pay the government less today, get a big deduction. If you sell down the line, you will pay it back, but you're paying it back with $1 with way less value than you would have in the first place. It's kind of the most simple I think I could put it.
Excellent. Appreciate that. Well, this is great. You know, before we move on any further, we got a question here from Craig Yarborough. Thanks, Craig. Are there any new provisions in this bill that give opportunity zones an advantage over 1031? And which of those two strategies do you think offers the most advantages? John, Brian, you guys want to take a first stab at this?
Sure. So real estate, if you're moving capital from one piece of real estate to another, those capital gains, almost always the 1031 is going to be better because you're basically deferring all those capital gains. And again, it could be a lifelong strategy. The opportunity zones give you a step-up basis after 10 years. But usually that's not going to pencil out nearly as well as the 1031 exchange. It's really designed more to bring capital from outside the real estate industry into the real estate industry through the opportunity funds. With the opportunity zones, you're going to be locked in for 10 years to get that step-up basis. Whereas with the real estate, you're using a deferral strategy that you can play out over your entire lifetime. If you, as long as you keep rolling and advancing and growing that portfolio to defer those capital gains. Brian, I don't know if you want to add anything to that.
No, I think you hit it on the head. I mean, the opportunity zone is really a mechanism to bring more capital into specific parts of the real estate industry. Low basis stock that, at a sale would be a significant gain, can then transition. I think, where it gets complicated is the mechanisms that you kind of engage in to get into these opportunity zones. It's a lot of funds that you have to kind of do some due diligence on, and just like any project, the economics have to make sense first and foremost, and hopefully the tax benefits are just a nice icing on the cake. But I agree. I mean, I think if you're just talking about real estate, I mean, 1031s are going to usually be the more beneficial route.
The technical term for what John was hitting on is called deferred, 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 die. So you just keep the ball rolling. The very highly technical term.
Out over a few years.
Yeah, years and years and years. Yeah.
Defer till you drop. Yeah.
Yeah. Yeah.
You know what? Let me jump in on the opportunity zones one more time, because I also have to mention that those are targeting pretty much development and redevelopment in lower income areas. Predominantly, those are all going to have to be designated census tracts, and the new opportunity zones will go into effect in 2027. They're going to designate all new census tracts. Now, some of them could be the same as they were previously, but they have to go back and go through the process entirely again, where each state declares certain areas that qualify based on income levels and other things to determine where this development can take place. So those opportunity zone funds are going in, and they're going to have to either develop real estate or redevelop the real estate. And there's a threshold on how much redevelopment investment has to be made. So they are, again, as an investor, with a 1031 exchange, you sell your property and you go pick the next one you're going to buy. With an opportunity zone fund, you're working through an intermediary who's targeting a specific spot, and they're going to come in and develop it or redevelop it. And after 10 years, you get that 10% step up basis. There's also in the new rules what's called a rural, I always have a hard time saying that word, rural opportunity zones, which have a 30% step up basis. But again, those are going to be in areas outside of major metros and are going to try to build development out in those areas. That's new. I haven't seen how that's really going to work yet, but it has a bigger benefit offering. I just don't know how it's ultimately going to play out from an investment standpoint.
Thank you for that additional insights there, John. Appreciate it. I had a feeling this was going to happen. We got a little roll of questions coming in here about cost seg and the potential for averting paying federal income taxes. So just a little clarifying question. There's a date that qualifies properties to be eligible for the 100% bonus depreciation. Kev, do you have that date offhand?
Yeah, so anything acquired after January 19th, 2025 gets the bonus. So if you bought in that pocket, it's going to be at a 40%, believe it or not. So anything after Jan 19th, 2025 gets 100% bonus depreciation treatment.
And I know there is some qualifiers for if you purchased it a little bit in advance of that, but it didn't go into service and there's construction. There are some details there that I've learned about. I would say, connect with Kev offline, and he can bring you some of the some definition to that if you have some additional questions on that. So thank you for your question, Barris. Let's see, John K. Can you explain how cost seg consultant works with the CPA or internal accounting team, particularly in the first year of a property being purchased, to take advantage of all of the deductions you mentioned? What happens first? CPA does their work, or who? So,
Sure. So the way I do it, everyone does it differently. There's a lot of bad actors out there who will try to sign you up for a deal without talking to your CPA first. I do not do that. I tell a guy, hey, let me run some analysis for you. When did you buy it? What did you pay for it? What's the address? Where's it at? Etc. And then I run an analysis, provide a nice summary. send it to you. We review it. I say, now send this to your tax guy. Better yet, bring your tax guy in the convo because yes, I could create a nice deduction for you. Can you even use it? I have no clue, right? So I just see a building and what we can deduct from it. I don't know if you're married, filed jointly, have partners, you had a huge loss from a bad investment. You may not even need it this year. So what I do is tell guys, let's collaborate with your tax advisor. I'm going to create a nice chess piece for you, but you and your tax guy decide when and how to use it. And so that's been my process that's worked incredibly well for me over the past decade.
Kev, is there a difference between using a cost seg in the first year of ownership or in service as opposed to waiting a year or 2 or 3 years?
Sure. Yeah. I mean, every year you wait, you're using your 12-month allotment of depreciation. So, if that's 30 grand, just to throw a number out of thin air, and you hold off on doing the cost seg another year, well, 30 grand of depreciation's been used. Bottom line, it's not going to break the bank. So very little difference, I'd say, majority of the time.
Okay, very good. We got another question here from Jim. Any other way to sell a real estate asset without paying less capital gains? Aside from 1031s,
Well, I mean, I think that was the intention behind the opportunity zones, right? And John, you can correct me. But yeah, the idea would be to invest in an opportunity zone, hold that investment for 10 years, and then get a very substantial decrease on any capital gains that exist. But of course, as we mentioned, these are projects that are development that are speculative in nature. The whole idea is to bring new investment into neighborhoods that need it. So unlike a 1031 where you can turn around and buy an existing cash flowing, asset that you can really understand and predict, you really have to get comfortable with speculative development risk and maybe a market you don't necessarily know that well. So I think that's how I would look at it.
Mhm. Yeah.
well, let's see. We got a couple of comments in here. I'll let you guys look through that as you'd like. From Charles, let's see. Are there any advantages for going green in this bill, or was the Inflation Reduction Act advantages gutted? I personally don't know the answer to this question, so I would lean on you guys for a response. I don't know if we're prepped for this question though.
I think personally, from the Biden administration to this one, the green stuff is taking a back seat, truthfully, but I didn't dive in like you just said, Don. I could speak to it from what I know, which is basically that. I know President Trump is not as green as the previous administration. So a lot of my clients who are doing solar developments and stuff, their projects are paused because now their whole deal metrics don't make all the sense that they once did. And that's pretty much all I know on that.
Okay. Any other thoughts?
There is one other thought. If you're a builder, you could use green zip tape, which is an IRS approved 100% congressionally backed drywall tape. That some big clients of ours, CBRE, Hines, have used. Which one used? No joke. We'll take your drywall, the studs holding up the drywall, the paint you put on the drywall, any electrical conduit going through the studs, any plumbing piping through the studs, and turn it into 5-year property because it's the only drywall tape that, when used, and again, it is green, allows you doesn't damage the drywall when you move it. So it's a movable wall. So the IRS deems walls that use this movable, and partition walls get 5-year treatment, and 5-year treatment is now subject to bonus. So shameless plug there, but it is a green product. So I figured I could tie it in easily there.
And that certainly would kind of supercharge any accelerated depreciation that's already happening on that building by just
Absolutely.
qualifying.
Absolutely.
Okay.
Absolutely.
On another note here, John, you had mentioned SALT, the state and local tax cap. Can you provide a little bit of detail on I know we're kind of segueing away from the accelerated depreciation, but this could be another advantage for people on the call to save some dollars.
Yeah, basically, there was a cap that was put in place on your state and local taxes. So, especially if you're in a high tax state, when you were writing off previously, back in the old days, you would just take your state and local taxes and you could write it off your federal taxes. And then in 2017, they said, nah, we don't like that idea. Let's put a limit on that. You can only write off up to $10,000. So that would be like your state property taxes and your income taxes at the state level. And that caused a pretty big disruption and pushback. It caused actually a lot of people to move between states. It was one of the forces driving a lot of the migration patterns, from New York down to Florida and so on. So they recalibrated that. They boosted it back up to $40,000, I think, and then it phases out for incomes over 500,000. Now I don't know exactly what all falls into that, but it's basically any of the taxes you're paying to your state and local governments would be expanded. How much of that you can write off on your federal taxes. So that's a big benefit.
Excellent. Brian, any other components of this bill that you'd like to talk about? I know you had mentioned one part about investment accounts that are created for newborns.
Yeah, I mean, I thought this was an interesting piece, not necessarily geared towards real estate, but something to be aware of. These accounts are intended to be established for anyone born next year in the amount of $1,000 that the federal government will establish for, again, all newborns. And some of the rules around it, as you can imagine, are being written still. But the idea is to give, people from the date of birth kind of a stake in the economic system that we have here, and hopefully over time build a little bit of a nest egg that they'll have access to when they turn 18, and anyone else is allowed to donate or to contribute to this account as well over time, up to $5,000, I think it is, per year.
Nice.
So I think, yeah, I mean, I think it's a great thing. I think it's something where, people graduate college and, you need to have a little bit of a nest egg to try to start a new business, buy a first home. And so, for those of us or anyone who's kind of going to be in that situation, either a kid or a grandkid, something kind of to be aware of that, again, I know we're not supposed to take positions on this, but I think it's certainly a positive thing for us to all to be aware of.
Yeah. I got a quick question, right? Does that money go into some form of investment vehicle? Where does it go? Just out of curiosity,
It's supposedly going to be administered by the Treasury Department and limited to like only ETFs. So,
Okay.
the intention is not to go into anything high risk. It's going to be a very stable, diversified, portfolio, which makes sense for a minor.
Yeah.
So yeah.
Yeah. It's not going to crypto.
No, that's not the intention, I don't think.
Got it. No, that's good.
Is there a major difference between that and a 529? Like, why choose one over the other? Or do both?
Well, I guess in this case the difference is just that you're getting that free $1,000, which is obviously a new provision that we haven't seen before.
Okay. Roberto Montano does have a question on regarding the SALT exemption. Is that a deduction or a credit?
I believe it's a deduction. Brian, you may know better.
It's a deduction against your income levels. So you start from the top and you slowly, kind of work down to get an adjusted gross income. And so those deductions were obviously very helpful as you got into higher income brackets. And so going from basically what was unlimited to capped at 10,000 under the previous law was pretty impactful, to the people, as John mentioned, in higher tax states like Illinois, like California, like New York. So yeah, that's how that worked.
Okay. Very good. Well, the only other thing I know we mentioned at the beginning would be to talk about R&D tax credits and maybe some qualified production property. John or Brian, Kevin, can you guys add any clarity to some of the changes in the big bill around any of those topics?
I would stay off the R&D. The 179D is energy efficiency credit where they boosted the amount of deduction you can take per square foot. So this is for guys who are doing large remodel projects that affect the envelope of the building. So the walls, the roof, things like that, and installing new systems. They basically, they go in and measure how much more efficient these new systems are versus the standard set in 2005. And depending where you are, you could get a square footage deduction up to $5.80 now. I've never seen one gone that high. I've done a few of these studies, but it's an energy efficiency study where they cranked up the price per square foot you could get. And again, that's for guys building ground up or doing a large remodel where the envelope of the building is affected.
Does that also have a start date, or can that be retroactively positioned against the building from years ago?
That's a good question. I'll look it up now while we move on, and then I'll chime in with the answer here. But yeah, good question. I don't know off the top of my head.
All right. Well, I know we're going to be wrapping it up here. Charles Connolly asked, what's the definition of a large remodel? You're probably talking about like gut rehabs or, a certain dollar amount.
I talk it in terms of square footage. So we'd say a large remodel, no joke, probably 20,000 square feet. That's what we mean by large. So if it's just a few units in a multifamily property, maybe not. We're happy to have a look, but then the price versus benefit of the study may not make cost benefit analysis may not make sense. So I've seen it work very well on larger scale projects.
Excellent. Well, as we wind down here, we might get a couple other questions put into the chat box here, and I would encourage y'all to do so as we wind down here. But maybe for some closing comments, John, Brian, and Don too. How would we look at? I guess maybe your closing comments should be kind of framed around what's the best way for housing providers, real estate investors to utilize these new tax advantages that are out to implement into their strategy.
Sure.
Brian, you wanna take it away?
Yeah, no, I mean, I think, what's great is again, one of the many things that's positive here is just a much more certainty. Of course, we can never say anything is 100% permanent, but we know rewriting these tax laws is a huge heavy lift. So I think we can feel pretty confident that these provisions will be here for the foreseeable future, and just that certainty. Again, this estate issue would have really forced some people into some dramatic replanning. We're avoiding that now, and I think it kind of allows us to continue to feel comfortable investing for the long term, seeing assets appreciate, and then having that adjust for inflation, I think is a huge positive. So in theory, all of this is fairly positive for the industry.
Mm-hmm.
Brian,
I guess.
Real quick, Kev. Brian,
yeah, no worries.
What's a good way for people to get in touch with you if they had some follow-up questions, or if you'd like, maybe drop your contact.
Yeah, I'll do that. And again, as John disclaimed, I'm not an expert on any of this on the taxes specifically, but we have plenty of people here at Northern that are, and many of our clients enjoy consulting with them, whether it's on the estate side or on the tax side. But yeah, I will do that, and I appreciate the time today, Tom.
You bet. Absolutely.
Fantastic.
Kevin?
I would chime in, Don too here. I took some good notes, no joke, and really liked how Brian and John started off. To me, it's all about planning. So get a team in place. You got to have a team. You can't just go out, underwrite a deal, and buy it without a couple exit strategies in mind, how long you're going to hold it, and like we all alluded to, that you can't guarantee anything. So I'm a big guy when it comes to collaboration. It's best to collaborate and get some other insights and make sure you're putting your best foot forward, because we all know real estate. We're talking real money here, and no matter how wealthy you are, it's easy to lose money in real estate as well. So get a team behind you.
Kev, how can people find you?
You can go to costedkev.com. The firm I'm with is ESSI, Cost Segregation Services Inc. It's my personal brand. And then all my contact info's there. And if you call me, I actually pick up. There's no assistance, no nothing. So you call me, I'll say, hello, Don Two here. You're dealing direct.
Awesome. Well, John, I would love to hear your final thoughts on here, and certainly if there's any bullet points that we missed in the conversation, please feel free to add those in now.
Sure, sure. So the fact that Kevin has a roll of tape on his desk and tax rules at his at
My
his on
fingertips.
hand,
Yeah.
and Don too, and his side job as a stand-up comedian. But there's a lot out there to think about. There's a huge barrage of headlines and news and media, and it all gets confusing. But we're really at a unique convergence point where these new tax rules allow you to sit down and make a long-term plan, because real estate is always a long-term plan. Very rarely you're thinking 1 or 2 years, but generally speaking, you're going out 5 years plus. So being able to plan over the long term is really important. I should mention also that we did produce a report about the tax rules from a real estate investment standpoint that we have released. It's on our website, marcusmillichap.com. You do have to log in or register, which requires an email address to access that report, but it is up there and you can go in and access that, and it has everything that my team put together. But we are at a unique space because we have all of these positive tax rules that take some of these deals that were maybe marginal and makes them, pushes them over the line into positive territory, especially on year one cash flow. We have interest rates that have just come down. I was looking at, the agency financing on apartments is down around 5% right now. Cap rates are at their highest level in, again, depending on the property type, the location, the highest level in over 6 up to 10 years, maybe more. So the cap rates have gone up, and the yield spread between the cost of capital and the returns, the cap rates, has moved back into positive territory. So you have positive leverage opportunities again. I know you guys are in Chicago, and Chicago had some of the strongest rent growth in the country over the last year. So there's a lot of things that are happening right now that are obscured by all of the news that we're seeing about everything else going on. And I think that that's something that everybody should be sitting down with, their estate planning and their tax advisors and their real estate brokers and their finance people, and sit down and say, hey, what is my roadmap for the next year? Because all of these things are aligning in the right direction for investment. And I think that a lot of investors are missing out on that opportunity.
Great. Wow. Sound advice there. Well, I really want to take a moment here just to thank our sponsor again, John Lamar, president of Paragon Heating, Cooling, and Tankless. Your sponsorship of this Zoom call was greatly appreciated, John. So thank you so much.